break-even analysis. Now by definition, you know that break-even analysis, it is also known as cost volume profit analysis. So in your study material you will find this written as CVP analysis or cost volume profit analysis. Now break-even analysis is the study of the relationship between selling price, sales volume, fixed cost, variable cost and profits at various levels of activity. A break-even analysis can be used to determine a company's break-even point. Break-even point is a level of activity at which the total revenue is equal to the total cost. So as per economics concept, you must have already studied this in microeconomics, that at break-even the company is in a position where the profitability is zero or the total revenue is exactly equal to the total cost. So at this level the company makes no profit. Now there are some assumptions behind break-even point analysis. First is the relevant range. That means the relevant range is the range of an activity over which the fixed cost will remain fixed in total and the variable cost per unit will remain constant. So the first assumption is fixed cost is not going to change, or there is no additional fixed cost. First. Second, variable cost changes proportionately. So the change in variable cost per unit is fixed. Total fixed costs are assumed to be constant in total, and total variable cost will increase with increasing number of units produced. The total revenue will increase with the increased number of units produced. So these are some of the assumptions behind break-even analysis. Now first we will see using graph how we can understand that. So if you will see first graph, on y-axis we have cost and on x-axis we have sales. You can see one parallel line which is known as fixed cost. Now since it is fixed in nature, so this is parallel to a number of units sold. It doesn't change. Okay. So even when there is no production or zero production, you have got some amount of fixed cost. Now if you see variable cost line, it starts from zero. That means at zero sales, your variable cost is zero. And as you are increasing number of units sold, the variable cost is changing proportionately. Right. Now if you see total cost line, it starts from fixed cost. That means even when your sales is zero, your total cost is equal to fixed amount of cost. And as the number of units sold is increasing, the total cost is also increasing and the line is almost parallel to variable cost because your total cost is also changing. Now if we come down to second graph, here again on x-axis and y-axis we have got same thing, but if you see this graph, because your sales revenue, that is the revenue generated by sales, so at zero number of units sold, this is also zero. So it starts from zero, like your variable cost, your sales revenue also starts from zero, whereas your total cost starts from the level of fixed cost. And as you increases the number of units sold, these two lines will go upward and there will be a point where the sales revenue line will touch the total cost line, and this is the point where the company's total revenue or sales revenue is exactly equal to total cost, or there is no profit or no loss situation for this particular company, and anything above that is profit. So you can see the profit is shown by a blue color here. So this particular zone is profit zone for this company. And if you go vertically opposite, so the vertically opposite triangle, the lower triangle, is the loss zone for this particular company. So break-even point is necessary to attain, because from there only the profitability starts to come for the company. Now that was shown using graph. How this can be, we can understand this using calculation. So again, this can, break even point is no profit, no loss situation. So the same thing can be also understood using calculation. So calculation method, contribution, it is defined as the excess of sales revenue over the variable cost. So we have already seen in marginal costing that contribution is equal to sales minus variable cost. So anything over variable cost till sales is your contribution, and the total contribution is equal to total fixed cost. Now sales is equal to total cost plus minus profitability. This we all know. Plus minus, because if it is minus then that is a loss, if that is a plus then that is a profitability. Now further, total cost can be divided, it can be expanded into fixed cost plus variable cost. So sales is equal to fixed cost plus variable cost plus minus profitability. Now at break even we know P is equal to 0, that is profitability is equal to 0. So at break even your sales will be equal to fixed cost plus variable cost. Now if you take sales to right hand side, so your fixed cost will become equal to sales minus variable cost. And if you want to calculate break even in units, so I have taken fixed cost to the right hand side, sales minus variable cost to left hand side. So it has become fixed cost divided by sales minus variable cost. So if you are asked to calculate break even in number of units to achieve break even, that will be equal to fixed cost divided by sales minus variable cost, and we know sales minus variable cost is contribution. So break even in units is equal to fixed cost divided by contribution. So here FC is fixed cost and C is contribution. So this is how break even can be calculated using calculation. So break even point is equal to fixed cost divided by contribution per unit. And if you are asked to calculate sales revenue at break even point, that will be simply break even point multiplied by selling price. Right. So you need to remember, contribution is equal to sales minus variable cost, and break even point is equal to fixed cost divided by contribution. In last slide, will it not always be equal to 1? Which one? Yeah, that is for 1 unit. See, so this ratio will always be equal to 1, right? And how many units will be sold to attain this ratio will be your break even in number of units. Okay, yeah, you are correct. That will always be equal to 1 because we have taken that from there. Now there are more mathematical formula related to break even point, like sales revenue at break even point. So sales revenue at break even point is equal to contribution required to break even divided by contribution to sales ratio. Contribution to sales ratio is also known as CS ratio, C by S ratio. And also break even point in units can be calculated as sales revenue at break even point divided by sales price, selling price. So these are some of the formula derived from break even equation, which can find their application in the numerical calculation, right? And I am not going much into mathematical detail because you are all going to appear in online mode exam, so you won't be asked any long answer based question. So that is why I am concentrating more on the concepts and less on the the discussion or the essay part questions. So let us take an example. Suppose selling price per unit is $12, variable cost per unit is $3, fixed cost is $45,000. Then you are required to calculate break even point. Now you see break even point in units is equal to fixed cost divided by contribution per unit, and contribution is sales minus variable cost. So you have got selling price, you have got variable cost. So here we are calculating this per unit basis. So we have simply found out contribution from selling price as well as variable cost per unit. So you can see break even point in unit is 5000 unit. That means you need to sell at least 5000 unit to attain break even point, and sales at that point will be 12, which is your selling price multiplied by 5000 unit, that is $60,000 of revenue. So you need to generate $60,000 of revenue to attain break even point. So now remember, till the time you attain break even, there is no profit for you. Okay, and see, contribution name, it has got its meaning. Why it is called contribution? Because contribution contributes to two things: fixed cost and profitability. Initially it will contribute to fixed cost, and when the fixed cost is fully recovered, then only it will start to contribute to profitability. Now in this question, if you see, fixed cost is $45,000. Okay, now if you sell one unit, the revenue generated from that minus variable cost will contribute to fixed cost, because you need to at least recover fixed cost to start earning profitability. And how much is fixed cost here? $45,000. So till the revenue of $45,000, there is no profit for this company. Okay, and why there is no profit? Because the contribution is contributing towards fixed cost, and at break even your contribution is exactly equal to what? At break even, contribution is exactly equal to what? Fixed cost. That's the right answer. So at break even, your contribution is exactly equal to fixed cost. That means you have recovered your fixed cost completely. Now whatever sales is coming next, that will be going directly towards your profitability after subtracting the variable cost, because variable cost will be changing. Now this kind of calculations are very much important for any company, especially those companies where the proportion of fixed cost is high. For example, aviation industry, automobile industry. Now if you see aviation industry, their fixed cost is huge. Okay, so if they recover their fixed cost, their variable cost will be less, because their variable cost will be some kind of expense done on the ticketing or net expense or internet expense or computer expense. That's all. Okay, so because for them fixed cost is a proportionately it carries a huge weightage. So these kind of industry needs to know when they are going to achieve break even point, because after break even point they have a kind of not complete monopoly, but kind of control over the pricing of their product. Okay, so if you see automobile sector, if you compare Maruti, even for that matter Hyundai, with any other company, so Maruti is in a better position to price their product, because they have been there for comparatively longer duration, and for some of the units they have already achieved the break even point. So after break even point, they are more flexible in terms of pricing, because the sales above break even will be directly contributing to profitability if you subtract variable cost. Now these calculations are done using alternate method. I have shown you two more formulas. So using the same formula, the same answer can be reached. The next concept is target profit. The target profit, it is a number of units, if you want to calculate, and it is fixed cost plus target profit divided by contribution per unit. So if you have got some profit as your target, see break even is your first target, but at break even you don't have any profit. So if you are targeting some amount of profit, so how many units you should be selling for that can be calculated using this formula. So again same example, Selling price per unit is $12, variable cost per unit is $3, fixed cost is same $45,000, and you have targeted a profit of $18,000, and you are asked to compute the sales volume required to. So you can easily calculate fixed cost plus target profit divided by contribution per unit, and it is 7,000 units. So if you remember, 6,000 units were required to achieve break-even point, and 7,000 with 7,000 units you are able to generate a profitability of $18,000, right? And you need to do a selling of $84,000 worth of product. So again, the same thing can be calculated using the another two formulas which I had shown. So the answer will be same. The next concept is margin of safety. Now, margin of safety, it's a measure of amount by which the sales may decrease before a company suffer a loss. This can be expressed as a number of units or a percentage of sales. So in a very simple term, it is the sales over break-even point. Sales over break-even point. So margin of safety is that zone which comes after you achieve break-even point. So margin of safety is nothing but budget sales level minus break-even sales level, right? So any sales which is more than break-even sales is your margin of safety zone. Now if you see the same graph, you can see we have attained break-even point where the sales revenue line is intersecting total cost. Now if you see this zone where profit is plotted, this is your margin of safety zone, because this is above break-even point. So if you are in the margin of safety zone, you are in a safe position because you have already achieved break-even. So companies they try to achieve margin of safety very fast, and they try to achieve as fast as possible. And as I took example of Maruti, so Maruti, if they are in margin of safety zone, so even if they face any problem in terms of say less demand in the market, or some new competitor has entered into the market, because in order to have an competition edge, you should have an edge over the pricing or selling price, and selling price edge can be achieved once you achieve break-even point. And that is why break-even point is a very important concept, whereas as well as it is very crucial for any company to know. Okay, and companies, they generally target when they are going to reach to break-even point, and sometimes they tend to achieve break-even point much before what they had planned, and sometimes they do that after a long delay also. Margin of safety is 0 at break-even point. Yes, correct. Margin of safety, it is nil, because at break-even point you are simply breaking even, right? So there is no margin of safety for you. So let us take an example. The break-even sales level is at 5,000 units. The company sets the target profit at $18,000 and the budget sales level at 7,000 units. Now you are required to calculate margin of safety in units and express it as a percentage of the budgeted sales revenue. So this is how your budget sales level is 7,000 unit, break-even sales level is 5,000 unit. So you are 2,000 units above the break-even sales or your margin of safety. So margin of safety indicates that the actual sales can fall by 2,000 unit or 28.6% from the budgeted level before losses are incurred. So this gives you a picture how much the decrease in sales is comfortable for you, or you are not reaching the loss zone, because if you are reaching loss zone, then your problem is again will be starting. So let us see how if we change some components of break even, how other components will be changed. Now if you'll see here, selling price per unit is $12, variable price per unit is $3, fixed cost is $45,000, and current profit is $18,000. Now suppose if selling price has been raised, because our assumption was that selling price is not changing, but in practical world it may change, it may increase, it may decrease. Now let us see if that happens, then what will happen to our break-even estimation. So if the selling price is raised from $12 to $13, the minimum volume of sales required to maintain the current profit will be fixed cost plus target profit divided by contribution, which will be equal to 6,300 unit. Now suppose fixed cost fall by $5,000, because again cost will be depending upon external factor. So if there is some government based pay fall, sometimes it may increase also. So if that happens, what happens to your break-even point? So this is how you can see the components change can be accommodated in the same formula. Please show the last solution of last problem, this one. The earlier slide, this is the earlier. Okay, we'll come back to this, right? We'll come back to this. When I'll be summarizing this process, I'll come back to the last slide, right? Yeah. So, I mean, this is how, if you have, because see, in real world, even the cost keeps changing, even the selling price can be changing, right? So, if that is happening, then how your break-even calculation will be changed. This is what I just tried to make clear using these two examples. Now limitations of break-even point. So like any error analysis, it is also prone to errors, prone to limitations. So break-even analysis assumes the fixed cost, variable cost and sales revenue to behave in a linear manner, which in real world does not happen. However, some overhead cost may be stepped in nature. The straight sales revenue line and total cost line tend to curve beyond certain level of production. So see, in real world again, even variable cost also does not change in the same proportion for the number of products. This may get kind of curve in by nature. It may be kind of curve. Sometimes it may be diminishing with unit of production. Sometimes it may be increasing also. Now in break-even, it was assumed that all products is sold. Again, that's not a practical assumption. The break-even chart does not take the changes in stock level into account. So the assumption is there is no closing stock. But when there is a closing stock, how break-even should take care of that is not actually addressed by break-even. Small and relatively simple companies that produces same product. It is not useful for companies producing multiple products. In fact, if it's, practically you will find same companies are maintaining or targeting break even for different product also. So break even could be product specific. It should not be only company specific. Like for example, Maruti. So Maruti can calculate break even for Swift. It can separately calculate break even for Alto. It can separately calculate break even for WagonR. So unit wise they can have a target of their break even point. Right. So these are some of the limitations of break even point, and of course this is very useful as I quoted some of the example. This helps company to have an edge over pricing, and that can further help a company to have an edge over the competitive market. Okay. So this is where I end break-even analysis. If you remember, we started with absorption costing, and We started with absorption costing, marginal costing. Absorption costing we did not take further because that was the traditional way of finding out the total cost, where all fixed cost and variable cost were included to calculate profitability. Marginal costing was more relevant for us because it concentrates on variable costing, and in actual it is only variable costing that changes with the production. So if you need to take some decision based on production, then only variable costing should be part of the consideration. So that is why marginal costing is more relevant as far as the costing is concerned. Then from there we move to break-even analysis, how marginal costing can help you to understand break-even analysis, achieve break-even analysis. Then we also have understood some components related to break-even analysis like fixed cost, variable cost, sales, profitability and contribution, and how these things are related. A break-even point in units is equal to fixed cost divided by contribution, and at break-even point your fixed cost is exactly equal to contribution, or your fixed cost is exactly recovered, and before break-even your contribution is only contributing towards the fixed cost and there is no profitability for you. After break-even the contribution starts to contribute towards profitability. Okay, so before break even there is no profitability for the company. So yeah, so any question? Have I made it clear? The break even analysis, marginal costing. Any question related to this concept? Okay, so